current whereabouts of the impending market crash are a topic of concern, especially as close to half of the buyers today are dealing with hefty monthly mortgage payments exceeding $2,600. Observing the surge in home prices and interest rates inching towards 8% on the Zillow app, everyone is wondering how and, more importantly, when this market bubble will finally blow up. Many individuals are finding it difficult to believe the current state of affairs. Despite the anticipated relief due to the record low demand, prices are holding firm or even rising in some markets. This can be attributed to the simultaneous occurrence of both record low demand and inventory, maintaining the balance in favor of stable prices. However, this delicate situation leaves the market vulnerable to a significant crash, a potential outcome that hasn't materialized yet but is a possibility given the underlying conditions. The recent data from the Mortgage Bankers of America sheds light on this precarious state, urging us to carefully analyze the market dynamics. The majority of individuals purchase houses through mortgages, and the current decrease in demand for mortgages has resulted in a notable decline in applications. The recent index tracking this data has dropped by 2.1% to 141.9, marking the lowest figure since 1995. This lack of interest in purchasing homes suggests a substantial reduction in demand compared to the historical average. Since the peak in late 2021, the demand has plummeted by over 50%, approaching record lows. Such a trend signals the possibility of a significant market crash, which is exacerbated by the anticipation of a potential surge in inventory. Even minor fluctuations in overall listings can significantly impact prices across the nation, particularly because the housing market operates under the principle of factor sparsity, commonly known as the law of the vital few. This principle implies that a housing crash can swiftly materialize in a market characterized by limited sales. In recent times, the number of home sales in a neighborhood has dropped to about one-third of the pre-2020 levels. It's highly likely that in the past year, there have been only a limited number of home sales in your neighborhood since the beginning of 2023. Consequently, it can be inferred that the pricing of just a few homes has influenced the prices of all the houses in your locality. In simpler terms, a mere 3 transactions have essentially impacted the pricing of as many as 300 homes. This highlights that a small number of transactions play a crucial role in determining price levels for an entire city. This phenomenon is also reflected in the Case-Shiller Index, which monitors home prices in the United States. Within a span of fewer than 3 years, this index can demonstrate significant fluctuations. Just as prices can rise rapidly, they can also plummet in a market with low liquidity and minimal demand. Even a slight increase in inventory levels could have substantial ramifications for the overall market. Understanding this, it becomes apparent that a potential market crash could be triggered by a handful of distressed sales. Similar to the speculations made by various researchers during the last crash, any future crash would likely stem from investor surrender. Throughout history, most market panics have been prompted by heavy selling. For instance, in the stock market, this might manifest as a margin call, where a borrower is compelled to sell off assets to recoup a part of their borrowed funds. In real estate, a comparable situation would arise, with investors facing significant losses being the first to withdraw. This tendency holds true, as investors are typically driven by the strongest incentive to sell. On the other hand, ordinary hardworking individuals, even if they have purchased an overpriced home that they can't afford, are more likely to strive to retain their property, given that it's their primary residence. If the crash initiates with investors, the subsequent question pertains to how and where it will unfold. Recent data from Redfin indicates a decrease in investor activity due to exorbitant rates, leading to a scarcity of viable real estate prospects. This trend particularly affects major cities typically prone to market bubbles, such as Vegas, Phoenix, and Miami. The current situation echoes past events, reminiscent of the 2008 crash, which primarily impacted these cities, resulting in significant losses. History seems to be repeating itself, with Phoenix experiencing a peak where investors were acquiring up to one-third of homes, and in certain neighborhoods, even half of the homes were investor-owned. Such an environment fosters a potential breeding ground for a rapid market downturn, triggered by the panic of even a single investor, leading to a domino effect in property devaluation across entire metropolitan areas in the U.S. Vegas serves as a glaring example, having suffered a substantial 62% price decline from 2006 to 2012, directly linked to investor speculation and avarice. During the crisis, prices plummeted alarmingly, with some sought-after neighborhoods witnessing even steeper declines. The market essentially disintegrated overnight, resembling the historical volatility of the tulip market. Recovery for Vegas has been a slow process, taking over 15 years to surpass its pre-2006 peak, leaving many in the real estate industry financially devastated. This account underscores the potential risks inherent in the current market, suggesting the possibility of a recurrence of the 2008 Vegas crash.